Hello to the members of the Delaware Association of Realtors and to all interested members of the public who care about short-term rentals in the state of Delaware. I'm Chrissy Steele, 2023 President of the Delaware Association of Realtors, and I'm joined here with 2023 President-elect George Thomason and Wes Stefanik, DAR's Chief Executive Officer. For more than 15 years, our association has been engaged in conversations around the taxation of short-term rental homes. Recently, Representative Kim Williams and Senator Spiros Manzavinos introduced legislation to do just that. House Bill 168, or also referred to as HB 168, would add an 8% state sales tax to the cost for short-term rental consumers. Groups like the Rehoboth Dewey Beach Chamber of Commerce, Southern Delaware Tourism, and the State Chamber want any consumer of short-term rental units in the state of Delaware to pay the exact same tax as someone staying in a hotel. What is a short-term rental? Well, the bill defines a short-term rental as any stay up to 150 days. Why 8%? Because 8% is currently the arbitrary tax percentage already found in law. As we saw at the recent hearing on HB 168, which was held only 5 days after the bill was introduced, these organizations made it clear that their opinion is focused on the matter of equity, that guests of hotels and short-term rentals are the same. They're not. Short-term rentals are stays in properties owned by individuals. Mom and pop type ownership makes up a vast majority of these properties. But aside from the equity discussion, we simply can't ignore the potential money grab this bill is. And it's important to note that Delaware has the highest state transfer tax in the country, and the state continues to do nothing substantial to lower it. While there's no official fiscal note attached to the bill, let's talk numbers, because everyone needs to be concerned about the impact on consumers, on homeowners, on vacationers, on those who need short-term rentals for their jobs. Now stick with us for just a second. Based on the hotel industry's projections last year, they estimate that the average rental unit goes for about $2,750 a week. They estimate a short-term rental unit to be rented around 10 weeks a season, or 10 weeks a year. That adds up to about $27,500 a year in income. Now add the 8% tax onto the renter, and that is $2,200 raised each year on each rental unit. Again, we're just averaging here. But then next they estimate there to be around 47,000 short-term rentals in Sussex County. Now simply multiply 47,000 rental units by $2,200 and HB 106 takes over $103 million from Sussex County short-term rental consumers a year. $103 million just in Sussex County. The proponents of HB 168 will harp on the fact that some of the money goes to beach replenishment and other programs. The fact is that only 12.5% of the tax is allocated to the beaches. Another 12.5% goes to groups that have shown up to support the bill, non-government, nonprofit organizations. The biggest money grab, though, is the state, getting over 62.5% of this money. So this bill represents a statewide solution for a very local issue. This unnecessary tax that could have been spent doing fun activities, such as eating at restaurants, renting a boat, going to the beach or an arcade, but because of HB 168, families will be required to pay even more just to make taxation between hotels and short-term rental units the same, for equity. Vacationers save all year for their Delaware visit. They specifically opt for a short-term rental based on a desire to be together in an affordable environment. This tax adds an undue burden that will put vacations out of reach for so many. We assume that people will always want to visit Delaware, and yes, we are focused on beaches, even though this would impact all rentals in the state, but we must be careful. This year alone, bookings are already down. We can't forget our other service providers, the linen companies, the maintenance companies, the cleaning services, similar types of service companies that are going to lose business when short-term rentals take a dive. We also want to note that according to the 2021 Value of the Tourism report commissioned by the Delaware Tourism Office, of the 9.8 million overnight visitors in the state of Delaware, 60% stayed in a short-term rental or a second home. This generated $620 million in tax revenue, which saved Delaware homeowners about $1,608 in taxes. For the amount of money the state wants to take from consumers and visitors, not to mention Delawareans who utilize short-term rentals, this bill moved way too easily through its first committee. Previous versions of the bill had an 11% tax cap. That disappeared in the most recent version. So this means that the state can raise the tax whenever they want and for however much they want. We're being told that we should just accept this tax because Delaware, California, and Alaska do not have a state tax on short-term rentals, but every other state does. In Delaware, we like to say we don't have a sales tax, that we're unique. Well, HB 168 is a sales tax. It's a vacation tax. It's bad for tourists, bad for vacationers, bad for Delaware small business owners, and bad for Delaware property owners. Call your legislators. Email your legislators. Respond to our call for action. Tell them to vote no on HB 168. Stay tuned for more updates from the Delaware Association of Realtors. Thank you.